What's going on, guys? Chris Hart here, sold out serving right now. If you're watching this video, you're either one of two groups of people. One, maybe you're a Search to Earn follower and you're subscribed to the channel and you came across this video, you're wondering what the heck is this? This is different from Chris's typical videos, guys. If that's you, stay tuned. If you're interested in learning more about what I do, how I built my business, how I built my wealth, my income, I'll be breaking down exactly what I do for my 9 to 5, more like 7 to 7, 7 days a week, right? Whatever you want to call it, 24/7, right? What I do to build income for my family, my businesses, how I'm leading a team across the country. Second group, maybe someone sent you this video, someone you just met recently, someone you've known for quite some time. The main purpose of this video is a couple things, guys. One, I'll give you my background, who I am, how I got started in financial services. Two, I'll break down the future of what's happening in this industry today and why it's so important to your finances. And then three, if you're saying, man, Chris, I'm just open to learning more about how money works today. We'll discover the 3 ways money grows, guys. We're breaking the 5 homes of money, the 5 financial institutions to build wealth in. And then if you stay tuned to the very end, guys, I'll show you exactly what I do daily to make income serving others. So who is Chris Hart, guys? Chris Hart, I'm originally from California, born and raised on the West Coast. Prior to working in financial services, worked at a little small company called Apple. They're actually quite big, right? At Apple, my job was to help companies integrate Apple technology, software, hardware. Loved Apple. I thought I was gonna retire there, but God had different plans for me. I met a guy at my church back in 2013, and we had some conversation about a company called PHP. Now, I asked him what it stood for. He said, people helping people. I thought it was pretty corny. I said, what do y'all do, man? He says, we help families make money, save money, and get out of debt. At the time, I was about 27 years old, had just gotten married. I thought, okay, as a new husband, I should probably be responsible with money and finances. So why not? Let me hear you out. The following Sunday we met at the church, guys, he blew me away. Not sure about you. My mom and dad did the best they can by me. But we never really quite had discussions about personal finances. It just wasn't a topic of discussion in my household. My years of high school and some college, never had a class on personal finances. So it made sense to me. I actually got started as a client with a company called Nationwide Financial and AIG. Now, the agent tried to recruit me. And I said, hey, man, hey, I work for Apple. At the time, we had $100 billion in the bank, as in me and Apple, guys. Obviously, guys, I didn't have $100 billion in the bank. Apple did. But my ego was tied to working for a big, sexy company, so I passed on the opportunity. But I come from a large family of 7 siblings, actually 6 siblings, 7 total. And so I gave him some referrals to my older brother and older sister. Couple of weeks go by, he calls back for more referrals. And I asked him, I said, hey, for sure I got more clients for you, but I'm just curious, what'd you make helping my older brother and older sister? He made about $7,000, guys, in about 2 hours of work. I thought, wow, $7,000, huh? I ain't getting any kickback, no referral fee, not even a Starbucks gift card, right? And so as he asked for more referrals, I said, as of right now, man, my entire family is set. That wasn't true, guys. But in the back of my head, I thought what he did was so easy, I can probably do it myself one day. So I had plans to get started with the agency. I procrastinated, I kept working at Apple. And eventually my wife says, hey, honey, I want to have kids. I'm like, that's start our family. We've been married for about 2.5 years now. She said, but I want to be a stay-at-home mom. I said, babe, there aren't any more stay-at-home moms. Like, this is the 21st century. Men work, women work, right? But she was serious. At the time, we were living in a suburb in Southern California. It was pretty expensive. I said, hey, we need a double income. So I have to find a side hustle. So I thought about PHP agency. So me and the agent, Curtis, we sat down and we had lunch. And I said, hey, if I can start with the company part-time, talking part-time, can I make an extra $2,000, $3,000 a month doing this business? Oh, Chris, you get started here, brother. You'll be a $250,000 earner in no time. I said, $250,000 a year? Don't sell me some crazy dream of making a $250,000 a year. Can I make an extra $2,000, $3,000 a month part-time, helping my family out? He says, yeah, guys, I figured worst case, I'll come on board, learn about money and finances. It'll be a win-win for my family. So I got started part-time. I got licensed in 1 month. Within 4 months, retired my wife. She didn't make crazy income. She made about $2,500 a month. But 1 year from my start day, I left Apple. So it wasn't some get-rich-quick scheme or some overnight sensation. It took some hard work and dedication. But fast forward today, God has definitely blessed us, guys. We have offices across the country from Riverside, California to Columbus, Ohio. We're in Memphis, Tennessee. We're in Atlanta, Georgia. We're in Charlotte, North Carolina, guys. We're actually heavily saturated in the DC, Maryland, Virginia market from Gaithersburg to Annapolis to the Silver Springs area all the way down to Fredericksburg, guys. We also have teams and offices in Connecticut and Brooklyn, New York. So, but enough about me, right? You're here today watching this YouTube video or this channel saying, hey, what is PHP Agency? What do you guys actually do? So PHP Agency, guys, we're an FMO. We're a financial marketing organization. What we do is we market financial products on behalf of companies like National Life Group, AIG, Allianz, and other Fortune 1000 companies. And right now, there's a huge shift taking place in our industry. These companies are actually shrinking and struggling to reach different markets. Why? Well, today the average agent in this industry is a 61-year-old Caucasian male. Now, nothing wrong with being 61 or being white, but here's the problem. He's got 1 foot in, 1 foot out, he's about to retire. Now, these companies do not care what color you are, how old you are, or where you come from. All they truly care about is the distribution of financial service products. But they know people normally buy from people who look, talk, and act like them. So the average agent is a 61-year-old Caucasian male. Who's he usually marketing to? Probably people from that demographic. So who's being left behind? You've got Gen Xers, right? They're in their 40s and early 50s, being left behind when it comes to financial education around money and finances. You have the Gen Zs. They're in their teens and 20s, not being targeted when it comes to financial literacy. You got millennials in their late 20s, 30s, and early 40s, not being taught to about how money works. And of course, you got minorities and you have women. So today, guys, PHP Agency, we're in a very unique position. We're one of the most diverse financial services companies in the country. Our CEO's name is a guy named Patrick Bet-David. He runs a channel on YouTube called Valuetainment, one of the best channels out there for entrepreneurs. And our mission, our crusade here is very simple. Saving America by bringing back free enterprise and hope to American families. We believe that if more Americans operating in free enterprise, we'll solve most of the problems in our communities. The challenge is no one's teaching us how business works today. So our company is very diverse, man. One of the most diverse companies in the industry, like I said earlier. And so we're actually 54% female, right? This is a good old boys club type of industry. We're dominated by women here at PHP Agency. Our company's also 42% Hispanic, 32% African American, about 13% Caucasian, and 1.2% other. Our #1 income earner is an African American Caucasian female named Sheen Sapala, making over $2 million a year in our industry, guys. Again, a woman of color who's a millennial is one of the highest income earners in our company. As you can see here, our company is super diverse. These are our top executives at the firm here, from African American to Nigerian American to Dominican, Mexican American, Salvadorian, Puerto Rican, Cuban, Caucasian, Ecuadorian, Jewish, and Caucasian guys. We're a different type of company that wants to attract a different type of agent. So imagine I said, hey, obviously we're talking about financial services here, guys, talking about insurance of all things, right? If I said, hey, let's go to an insurance conference tomorrow morning, how would that sound? Probably sounds pretty freaking boring, right? Who wants to go to an insurance conference, right? But our conferences are a little different. What if I said we'll have Kevin Hart out there? We had Kevin Hart come out to one of our conferences, chocolate drop himself, did his irresponsible tour at a PHP conference. The late great Kobe Bryant came out to a conference a couple years back. We've had Shaquille O'Neal. We've had Magic Johnson. George W. Bush has been out to our events, guys. We're a different type of company that wants to attract a different type of agent. So anyone working with us believes in and buys into entrepreneurship. Now, as entrepreneurs, I don't care what you sell, what product you offer, what you do for money. As entrepreneurs, we get paid based off the size of the problems we solve. We're solving 3 problems here at PHP Agency. One is called distribution. Guys, I do not resemble the typical agent in our industry. I have access to a market that the average agent has a hard time getting to. Therefore, these companies that pay me very well to teach people who look, talk, and act like me about money and finances. Whether you're a woman, whether you're a Gen Z, a Gen Xer, you have access to a market that Nationwide, John Hancock, AIG, these companies want access to. They'll pay you well. They'll teach people who look, talk, and act like you about money and finances. That's the first problem we're solving. Second one, guys, is just going to be financial literacy. We don't learn how money works in America today. Most of us learn from what? The school of hard knocks. Making mistakes in our 20s and our 30s, trying to recover by our 40s to get back on track in time for retirement by our 50s and 60s. Not the best wisdom, but it's all we know. We teach financial literacy here. How's your 401k work? Your 403b, IRA, Roth IRA? What's tax code 7702? What's an infinite banking concept? How does taxation and inflation impact your retirement and your wealth? Simple financial terms we teach for free here. And last but not least, guys, it's just entrepreneurship. I don't care how old you are in America today. If you're saying, man, Chris, I want to open a business, man, you have to attract 2 of the largest living generations. They're called Gen Zs and Millennials. And they're different, man. They're born between 1981 and 2010. Most of them don't want to work at a job for 40 years, for a 401k, for 45k a year. They want to travel, live their best life, get paid what they're worth, and have an impact on their community and the world. Last time I checked, that's very hard to do behind a desk or a kiosk. it requires entrepreneurship. Who's teaching us entrepreneurship? No one really is. So if you're wondering, okay, cool, Chris, man, great introduction. Like, how are y'all solving these problems, right? One of the first concepts we teach here at PhD Agency, guys, is truly about money. But not just money, guys. More importantly, how does money grow? I don't care how much money you have or how little you have. Your money is growing three ways, right? It's either going fixed, variable, or index. This is one of the first concepts we teach our clients about in our workshops, guys. So there's pros and cons to each way money works, right? There's a plus and a minus to it. The first one here is going to be called fixed. What's fixed? It's going to be your bank, checking account, your savings, your CD, money market, the shoebox upstairs. Some people still have money in shoeboxes, right? Now, what's the plus to putting money in a shoebox or a bank? Safe, man. The bank is backed up by the FDIC up to $250,000 deposits, right? Your money's safe in the bank. What's the downside to the bank? Little to no growth. Anywhere from 0 to 1% if you're lucky, right? One of the biggest challenges you face in the banks is something called inflation, right? You have inflation risk. So inflation is currently around 8.8%. You're actually losing money by saving it in a bank, right? Looking at a growth chart here, this is how it looks. You got slow growth over time, not the best place to actually grow money. But a lot of us are taught, hey, get a CD, get a money market, get a high yield savings account, put a ton of money in there, right? Now the second one here is called variable. Most of my clients who own a variable account, they own it due to an employee-sponsored account. Maybe you have a 401k out there or a 403b, TSP, 457 deferred comp. Maybe you have a Roth IRA or an IRA. Maybe you own some cryptocurrencies. You're saying, Chris, I just buy individual stocks through Charles Schwab or Fidelity, right? Maybe you own some real estate property, Airbnb rentals, right? These are all variable accounts. They're great to have, right? What's the plus to owning a rental property or to having some stock in Apple or having a 401k? You can experience growth in the market 100%. Now, what's the downside to sometimes owning real estate or having stocks or having a 401k? What goes up at some point must come down. You could lose all or a portion of your money in a variable account, guys, right? Looking at the last year of this market, we're currently shooting this, guys, in the year 2022. And the market's pretty volatile right now, man. Down, the S&P's down plus negative 20%. And so here's how the market's looked the last 18 months. Kind of up, down, up, down, crash. The real question is this: how much money can you afford to lose? Most of my clients say none. So the last one here is index. Now, index is not as popular as fixed and variable. Why? Remember, the average agent marketing index products is not reaching all markets. Most of my clients never even heard of it. It's called a fixed index annuity or index universal life. Fixed index annuity or index universal life. These are both insurance products, guys. Insurance has a disposition to not lose value. You have a contractual agreement saying you're guaranteed to never lose money in its accounts. The plus is pretty obvious. It is absolutely safe. What's the catch? There's got to be a catch, right? I always heard there's got to be a catch. There is a catch. It's usually capped on growth. I'll use a simple example here of 0 to 9%. What does that mean? You won't get below 0. You won't lose any money, but you won't get above 9% growth. Your cap is 9. Your floor is 0. Now, when we say index, what does index mean? When we say index, it's tracking an index. It's tracking something. What does that mean? Let's just say it's tracking what we call the S&P 500. Some of your most popular stocks in the market, from American Express to Microsoft to you have Apple, Tesla, Amazon, Netflix, all these big brands, right? Let's imagine you said, Chris, I want to grow some money tied to the performance of Procter & Gamble, of Walmart, Coca-Cola, these big brands. You can do that here. Now, let's say the S&P 500 was up positive 20%. It's a pretty solid year. What would you experience in your IUL in growth? Well, the market did 20, you're capped at 9. You would get 9%. That's the downside to going index. You only got 9%, you could have got 20. Now, still way better than the bank, but not quite 20%. Let's say the following year the market's up 8%. Solid year of growth, I'll take that. If the market was up to 8%, the S&P 500, you had money in the IUL, what would you experience? Your cap is 9, market did 8, you get all the gains of the market that year, right? All the gains of any risk. Now the following year, let's just say we had a repeat of what happened back in 08. Subprime loans, housing market crash, right? Sort of what's happening right now in the year 2022. Different scenario, but same losses are taking place as we speak. Let's say the market was down negative 38%. Woo! How much money would you lose in your index? 0. Zero is your hero. You don't lose money in the index, guys. Looking at a growth trade, you're probably wondering, how is that even possible? Here's how it looks. When the market's up, you're up. When it's down, you're flat. Up, you're up. Down, you're flat. Up, you're up. Down, you're flat. So forth and so on. Locking in your gains and keeping your principal protection in place, right? So looking at all three ways money grows here, if you had an opportunity to go money for your family's future, for your next down payment for a house, to invest into real estate, college for your kids, retirement plan, whatever it may be, where would you put most of your money? Would you put it in fixed? Would you put it in variable? Or would you put it in index? Most of my clients say index. Some say fixed, few say variable. I believe in all three. If someone says put all your marbles in one basket, I would be careful about that, guys. When it comes to fixed accounts, well, we enjoy the safety, man. We work hard for our money and no one wants to lose money. But we don't like the low growth. What should be in there? Anywhere from 3 to 6 months of your monthly expenses. Whatever your bills are monthly, add that up times 3 to 6. You want to have a cash reserve in the bank just in case an emergency. You want to have cash on hand. Now, when it comes to our variable accounts, we enjoy the growth of our 401k, our TSP IRAs, but we don't like losing money. So what should be in there? It's really based off three factors: your age, your income, and your wealth. The older you get, the less money you want to risk in a variable account. If you're close to the retirement, knock on retirement's door, you lost half your portfolio, what do? You work 5 more years. It's not safe. Now, if you possess great wealth, you make great income, take some risk in the market. You could afford to lose something. It's really based off each individual person. And the last one here, guys, is index. It's safe and it grows. Kind of has the best of both worlds. You ever heard of a guy named Warren Buffett? I'm sure you have, right? Warren Buffett, he's a financial guru, billionaire, has all these books on money and finances. If you ever read a book or an article from Warren Buffett, he's got 2 rules of money. His first rule of money is this: do not lose money. Okay, it makes sense, check off, right? Don't lose money. Rule number 2, do not forget rule number 1. He keeps it quite simple. Just don't lose money. Here's the problem though, guys. If you're like me growing up, most of us only taught certainties about money and finance. We're taught, hey, get a 401k and a checking account. Get a 403b and a savings. Get some CDs and money markets accounts and some stocks or some bonds or mutual funds, right? That's all we're taught. When he's saying don't lose money, he's not saying put in the bank. No, he's saying something called principal protection of your wealth and your money. What does that mean? Let's imagine we all had $100. I'm going to give you today $100. There you go, right? And we said, let's invest this $100 into a stock, into a property, into a variable account, whatever it may be, cryptocurrency. And that account goes down negative 50%. How much money will we have left? Well, we had $100, lost 50%, lost half of it. We're at $50, right? Makes sense. Let's say whatever that account was, the real estate market, cryptocurrency, it bounced back up the following quarter. It was back up 50%. Where are you at now? If you said $100 at first look, take one more look at it. Said $75, you were absolutely right. You got 50% of 50, which is $25. What does that show us? Whenever the market has a correction, it takes twice as much growth of what was lost to get back to square one. That's why in most cases, not losing money got to be more important than making money. So as you wrap up here, guys, on these 3 ways money grows, I have a question for you. What do you currently have now? How are you currently growing your family's wealth or saving money, right? If it comes to fixed accounts, when I ask my clients, do you currently own any fixed accounts, guys, 9 out of 10 say yeah. Second one here is variable. When I ask my clients, do you currently own any variable accounts? 8 out of 10 say yeah. They have a 401k retirement account, they have a pension, they have a 403b, TSP, some stocks, right? When I ask my clients, do you currently own any fixed index annuities or index universal life products, guys, guess what 8 out of 10 say? They say no. When I ask them why not, they say, Chris, quite frankly, I never heard of it. So if that's you watching this today saying, man, Chris, I've never heard of an IUL or a fixed index, I highly suggest whoever sent this video to you guys, reach back out to them and say, hey man, I'm just open to learning more about how money grows. And if that's you watching this today, what we'll do is something very simple. We'll set up a second appointment, guys, and just ask questions about what's important to you. Is it retirement planning, long-term savings, college for kids? Buying your first investment vehicle in real estate, buying your first home, taking care of your aging parents, what's important to you? We'll show you how an indexing strategy could potentially bring value to your family financially. Now we've learned the 3 ways money grows, right? The next line of sequence is very simple. Okay, I know how money grows now. It grows fixed, it grows variable, it grows index. Very simple. I broke it down, Chris. Thank you. I understand. Next question is this: where should we put our money? There are 5 homes of money out there, 5 financial institutions to put your money into, right? We call them the 5 homes of money here at PHP Agency. The first one's going to be the bank. Bank is very simple, right? Checking account, savings account. We all have banks, right? Or credit unions. Second home is going to be the stock market, right? It's going to be your individual stocks. It's going to include cryptocurrency, forex markets, all that great stuff. Third home is going to be qualified plans. That's your employee sponsored account, your pension, your 401k, TSP, IRA, all that good stuff. That fourth home is going to be real estate. Investing into real estate, flips, wholesale, Airbnb rentals, units, all that great stuff. And then you have something called life insurance. Now, before choosing which home is right for you, there are 5 key characteristics to look at when using these homes. The first one's called liquidity. Liquidity states, do I have access to my money within 24 to 48 hours? Is my money liquid? If I need it by Thursday, by Friday, it's Tuesday, it's Wednesday, can I get it, right? 2 is going to be something called safety of principal. Can you guarantee me if I have money in this home, I will not lose any of my principal, value, or balance? And then you have taxes, right? You have tax deduction that says, hey, if I put money into that home, does it bring my taxable income down for the year? And then tax advantage says, hey, once the money's in that home, how does the IRS treat it? Is it taxed now, taxed later, or taxed never? Now, if you could be taxed now, your money in that home, now, later, or never, what would you pick? Most people say never. We'll show you today a strategy on how the wealthy avoid taxes on their growth. And the last one here, guys, is going to be just growth. Now, when we say growth, we don't mean 2.5%, 1.5%. Growth to us means this. Does that account, does that home outpace inflation? If it's not outpacing inflation or it can't do it potentially, it's not really growing. So before moving forward, guys, you see here, very simply put, above each home, we have either an F, a V, or an I. We just learned how money grows in this video here, right? 3 ways money grows. We know money grows fixed, so banks are F for fixed. The stock market, your qualified plan, real estate are all V for variable, kind of up and down. And then life insurance is I for an index. Here's what we'll do, guys. We'll keep it very simple here. What we'll do is look to the left, and we'll put a plus in every box that shares those characteristics, and a minus if it doesn't. At the very end, add up all the scores and see which home has the highest score. So, first one here, the first line here, guys, is called liquidity. Liquidity is very simple. Do I have access to cash within 24 to 48 hours? Is a bank liquid? Absolutely, right. We have a checking account, savings account. We have an ATM card. We can go to the ATM, get cash from our accounts whenever we want. Now, what about the stock market? Is the stock market liquid? It actually is. Some say no, but guys, technology over the last 10 years, you can do trading on E-Trade. You have your Robinhood account, all these different accounts, right? Acorns. You can go sell, say, your cryptocurrency on Coinbase and get access to your cash fairly quickly nowadays. Now, what about my qualified plan? Is my 401k liquid? Is my pension liquid? Absolutely not, right? Not until qualifying age can you actually get access to the cash in your account. And then 2, if you put money out prematurely, you'll get hit with some pretty hefty taxes, federal taxes, state taxes, and federal penalties. So this is not liquid funds. And you could borrow money from a 401k. I know many clients who have done it in the past, but that money has to be paid back. If not, you're paying those penalties. And the fourth one here, guys, is going to be real estate. Real estate is definitely not liquid. Imagine if you had a 60-unit apartment complex and you needed cash tomorrow, the next day, 48 hours. It'll take you some time to do a short sale to get rid of that property, right? Real estate is one of the best investments to actually have, 100% the whole long term, but not very liquid. And the last one here, guys, is life insurance. Is life insurance liquid? Most think it's not. It actually is. If you had cash value in a life insurance policy, you have access to your surrender value. You can actually put the cash in that policy at that time to do what you want with it, right? And it's absolutely liquid. That money's in your account within 1 to 2 days. Now, next line here, guys, is going to be safety of principal. Remember, safety of principal. Can you guarantee me I cannot lose any value in that account? The bank is definitely safe up to the threshold of $250,000 according to the FDIC. Can you guarantee me safety in the stock market? Absolutely not, right? The market's kind of up and down. It's very variable. Now, looking at my qualified plan, can you guarantee me safety in my 401k, my TSP, my 403b? What is the stock market? What is your 401k tied to? Majority of 401ks are tied to the stock market. So the market's up and down, your 401k is also up and down. It is variable up and down, so you can't guarantee safety there. When it comes to real estate, can you guarantee me safety in the real estate market? We made an investment on a property. It's not going to lose value guaranteed. We all know real estate over the long run grows. It appreciates, but you cannot guarantee me that appreciation in this season. And then we have something called life insurance. Now, is life insurance safe? It's index, right? The floor is zero. Depending on what policy it is, especially if it's an index universal life insurance policy, it is absolutely safe at a floor of 0%. Now, the next line here, guys, is taxes. Now, taxes are a huge part of not only building wealth, but also preserving and keeping it, right? And so when it comes to the banks offer any tax deductions or advantages? Absolutely not. The bank is the bank, right? What about now when it comes to the stock market? Is there a tax deduction when buying stock or selling stocks, right? No, not at all. There is no tax deduction. You will pay capital gains taxes on the sale of those stocks, so there is no tax advantage on the back end. Now, what about the stock? What about my 401k, my qualified plan, my IRA? Is there a tax deduction when it comes to 401ks? Absolutely. Most Americans partake in this, right? I used to work for Apple. Let's say I made 100K at Apple, right? And I put 15K into a 401k. Boom. On paper, I made $85,000 because pre-payroll deductions, like I had deduction on that account, 15 grand went into my 401k. This is great. I made 85 grand on paper, putting me into a potential lower tax bracket. That's what most of us do. Is that a good thing or a bad thing? Obviously, it's a good thing, right? Yes, it is, but wait for a second. Let me ask you a question. How do you feel about taxes? Are taxes going up or going down? Taxes are going up in America. They always go up historically. I don't care if it's a Democratic party or the Dems are in power or the Republicans are in power. It doesn't really matter. Taxes always increase. So if me and you can agree taxes are always increased historically the last 100 years, walk me through this explanation really quick. I have a 401k at Apple. I put 15 grand into a 401k, and that account grows over the years. I save diligently up to my 30s, my 40s, 50s, early 60s. I saved $1.2 million in my 401k. So you got $1.2 million in your 401k. Great job. Now, you get taxed in the future on that money when taxes are higher. Who does that benefit? Not us, Uncle Sam. Then why do we do it? It's all we know for most of us, right? Get a 401k at a job, and new payroll enrollment, HR, all that great stuff. You buy into the 401k, your 403b, your TSP, and before you know it, you're 62 years old. You're knocking on retirement's door. You got $800k, $1.2 million in 401k that has not been touched yet, and it's going to be taxed. And we know taxes are increasing in our country. So what do? Some people say, Chris, I'm aware of that. Guess what I have? I have a Roth 401k. So the Roth 401k here, guys, is going to be a tax advantage, right? It says, hey, man, tax me today. I'm aware of this. I want to grow my tax-free retirement, tax-free, so my Roth IRA grows, and when I retire in the future, that's all of my money. I don't care what's happening in Congress. I am not going to be taxed at future tax rates. There's one problem about Roth IRAs, guys. They're phenomenal products, right? Here's a problem. There's a limitation on them. $6,000 a year. If you're qualifying age, you can catch up to $7,000 a year. So you can't put too much away there. And if you make too much money, you don't qualify for it. So if you make too much money, you don't qualify for it. If you can't qualify for it, you can't save too much. So it is definitely limited on what it can do for you. And there's no liquidity there because you can only touch the money you put in, not the actual growth of a Roth IRA. But great product for most people. Next one here, guys, is going to be real estate. Now, does real estate offer a tax deduction? Obviously, it says no here. Most people say it does. The purchase of a real estate property does not offer a tax deduction, but the ownership absolutely does. That's called a tax advantage. You can write off the appreciation of the house, the depreciation of the house. You can write off the interest, the taxes. It's great owning real estate from a tax perspective. And then the next one here, guys, is going to be life insurance. Does life insurance offer a tax deduction? It does not offer that when it comes to regular payments being paid, right? If you're a civilian, or not a civilian, but if you're a client who is putting money into a policy, you're paying your monthly premiums, you cannot write that off. Now, if you were a corporation, you could do something called an executive bonus or a double bonus where the C Corp pays cash through a payroll to a C-level executive like the CEO or a CIO or a CFO, and that is considered an executive bonus where it's a write-off for the corporation, a double bonus, so that the taxes are taken care for by the corporation for the employee. But that's not most people who have fallen into that realm. For most employees out there, most clients out there, they're not getting a tax deduction or insurance policy, but they are getting a tax advantage. Similar to a Roth IRA, the cash in a life insurance policy falling under tax code 7702 does grow tax-free. You have tax-free access to that money, and there's no limits on contributions. Save $100 a month or save $1,000 a month. Put in $10,000 a year or $10,000 a quarter. Totally up to you on what you want to set aside in that policy. If properly structured, it can be a phenomenal tool to building wealth. Now, the last line here, guys, is real simple. This is growth. When we say growth, we mean growth, right? Does it outpace inflation? The bank cannot outpace inflation, obviously, but the rest of these accounts actually can. When it comes to the stock market, when it comes to qualified plans, on real estate and insurance, these all have the ability to outpace inflation. So as you wrap up 5 homes of money here, we see that banks have a score of 2 out of 5. Banks are good for 2 things: liquidity and safety. Having access to my money and it being safe. The stock market is also good for 2 things: liquidity, having access to cash fairly quickly, and growth. It can definitely experience great growth in the stock market. And then you have your qualified plans, which is good for really, it says 3 here, but really 2 out of 3. You can get Roth and non-Roth in one brokerage account, but not in one fund. And so you have a score of 3 out of 5 here. It's great from a tax advantage and tax deduction, and offers some good growth, but it's not liquid, it's not safe. And then you have real estate here, which is a very popular way to build wealth, but it only has a score of 2 out of 5. More of a long-term thing. You got great tax advantages and growth, no liquidity. You can't guarantee me safety or principal. There aren't any true tax deductions. And the last one here, guys, is life insurance. Life insurance has a score of 4 out of 5. It's liquid, it's safe, offers tax advantages and growth. Now, prior to this video, would you have ever thought that life insurance could be the best home to build wealth in? Most people say no to that answer, right? What the heck, life insurance, guys? But let me give you a quick preview. Have you ever heard of a concept called BOLI? B-O-L-I. BOLI. Look it up. Google it. Put it in your web browser today. So after this video, guys, type it in, take your notes. BOLI, B-O-L-I, bank-owned life insurance. Let me ask you a question. Why does Bank of America, Wells Fargo, J.P. Morgan Chase, Citigroup, U.S. Bank, and Truist have billions and billions of cash in life insurance? Why? Well, they know this here. Life insurance offers them the ability to have liquidity in their funds, to have safety, to have growth and tax advantages. So we make our deposits to our bank every 2 weeks, right over our payroll. We deposit to the bank. The bank leverages life insurance to build wealth for our money. And what do we get? We get some liquidity and we get some safety, but they keep the tax advantages and the growth. So if you're saying, man, Chris, I'm open to learning more about that 5th home of money, I highly suggest whoever sent this video to you guys, give them a call back. When they text you, have you watched the video? Say, yes, I did. And here's what's next for you. This is next for you because you have to take your finances into your own hands. Say, hey, I'm open to a follow-up. Simple as that. And what we'll do is simple. Just teach you more about how these policies work. If you've never seen an infinite banking concept before, you've never seen max funded IUL or alert life insurance retirement plan, I highly suggest you say, hey, I'm open to a follow-up just to learn more. And based off how that second appointment goes, in the future, if you want to look at more serious plans, we'll show you a plan and a strategy for your family's future, guys. So now you've seen exactly how we serve our families, how we educate them on money and finance, guys. Maybe you're someone saying, man, Chris, how do you guys get paid here? I'm looking for a side hustle, man. I'm looking for a new career. I'm looking for a way to make extra income. Chris, you worked at Apple, walked away from Apple. You're doing this thing full time. You're traveling the world, man. You've been to, just in the last 18 months, you've been to Tulum, Cancun, you've been to Monaco, I've been to Paris, been all around the country, right? So how can I do what you do daily and serve families, guys?